Assalamualaikum warahmatullahi wabarakatuh. 2.0 Raini binti Zainul Abidin. We Group 1 will present about Topic 1 from the Cost and Management Accounting. Before we get into it, let me introduce you to our group members. First one, we have Danish Daniel Reza bin Rosli. Next, we have Muhammad Faik Akmal bin Muhammad Anwar. The third one is Nur Akmal Serina binti Muhammad Azmi. And we have Nur Shafiza binti Jamluddin, Nur Farisha Erina binti Jamaluddin, and last but not least, Nurul Atika binti Jamaluddin Ahmad. Next, we have Table of Content, which contain 1.1, the concept, principle, methods, and technique of cost, and 1.2, the calculation of the cost accumulation and cost assignment.
My name is Nur Farisha Elina binti Jamaluddin. My metric number is 01DAT20F1019. Today, I will present about the definition of cost accounting and the importance of cost accounting. First of all, we need to know the definition of cost accounting. Chartered Institute of Management Accountants states that cost accounting is the establishment of budget, standard costs, and actual costs of operation, processes, activities or products, and the analysis of variances, profitability, or the social use of funds. Whereas Charles T. Holmgren says that cost accounting is a quantitative method that accumulates, classifies, summarizes, and interprets information for three major purposes. First, operational planning and controlling. Second, special decision. And third, product decision. From the definition, we know that cost accounting is concerned with the ascertainment of cost for each product that is made or each service that is given. Cost information from cost accounting is used to aid planning and decision making that affects ongoing operations. Not only that, cost accounting also plays an important role in controlling the cost of production. If the difference from the original plan is significant, the manager should change the inefficient aspect or do some adjustment according to the original plans. From that, it shows that cost accounting is concerned with establishing where things are going wrong and where action is necessary. Next, cost accounting involves the process of recording, classifying, and analyzing all the costs involved in production, such as costs for direct materials, direct labor, and overhead. In other words, it is a systematic procedure for determining the total cost and unit cost of output. Management uses the data to determine the price, reduce the cost, maximize the profit, and others. In short, we can say that cost accounting processes involve financial and non-financial information relating to the cost acquiring resources in an organization. Last but not least, cost accounting provides information that is required for management accounting and financial accounting. For example, production cost data is used in helping managers to set the price of products. So, however, cost data of production is also used by financial accounting in valuing inventory to prepare the balance sheet. The diagram below shows the uses of cost accounting data for financial accounting and management accounting. Next, I will continue this presentation by explaining the importance of cost accounting. As we know, cost accounting information can provide benefits to many parties, especially management. Information from cost accounting department can help management to formulate the company's business policies. So, this is the importance of cost accounting. Firstly, ascertaining cost and guiding selling price fixation. Many factors are considered while fixing the price of a product, such as competitors, the quality of the product, area of distribution, condition of market, quantity of supplies, and so on. One of the major factors that affects price determination is the cost of production. Then, cost accounting provides information regarding the cost to make and sell product or provide the service. However, the important things in deciding the selling price of a product is product cost and cost per unit. In order to generate profits, the selling price should be higher than cost. For example, if the product cost per unit is 10 ringgit, seller must sell the product at a higher price than 10 ringgit, such as 25 ringgit or 30 ringgit to earn a profit. The second importance is facilitating planning. Planning begins with the selection of objectives or goals of the organization. Planning can be classified into strategic and operation planning. For the strategic planning, it involves long-term decision-making such as the purchase of long-term assets, expansion of the business, and so on. Meanwhile, for the operation planning, it involves short-term decision-making. Operation planning for production requires decision-making regarding the availability of resources such as raw material and labor. In developing plans for the future, cost accounting will be used to analyze the cost of past operations and production to plan the future costs. So, the relevant historical costs must be adjusted to reflect any changes in future production. From that point, the management will determine the activities that are to be carried out in the future and a formal plan called a budget will be adopted. For example, the cost of production for last month had increased because of the increase in the rate of wages. In the response for this situation, the management could plan for the next operation and decide whether they should reduce the wages or change the method of production to reduce the cost. Next, the importance of cost accounting is facilitating controlling. The objective of controlling process is to ensure that the work is done to fulfill the firm's objective and plan. Cost accounting provides detailed costing information to help the management to maintain effective control, increase efficiency, and check wastage or losses. Knowledge of the cost is also necessary to check on the cost of products or control wastage. Then, the unprofitable activities are identified by using cost accounting data, so that corrective action may be taken. Companies must manage their costs effectively to become the supplier with lowest cost and compete on the basic selling price. For example, if the cost of production rises due to raw material costs, the manager can source for an alternative supplier to supply raw material at a lower cost. Last but not least, the importance of cost accounting is providing information for short-term and long-term decision-making. A cost accounting system provides cost information to facilitate decision-making. The decision-making process involves searching for alternative courses of action, evaluating them, and then selecting the best among them. Accurate cost information is important in decision-making for distinguishing between profitable and unprofitable activities. Decision-making can be divided into short-term decision-making and long-term decision-making. Routine operating decision, also known as tactical decision, and it has short-term implications. These decisions aim to improve short-term profitability. For some examples, make or buy a particular component, whether to outsource a particular job, price for special order, the most profitable product mix, and profits at different levels of production. Meanwhile, long-term decision-making is also known as strategic planning, and it has long-term implications. For example, pricing of new products, development of new products, development of new markets, developing existing products, and developing existing markets. To help the management of a company make the appropriate selection, the cost accountant provides information about how future revenue or costs will differ under each alternative option. This information is very important to assist management in the decision-making process.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Atika binti Jamaluddin Ahmad. My metric number is 01D8020F1014. Today I'm going to present about the differences between cost accounting and financial accounting. There are 11 differences between cost accounting and financial accounting, and we're going to see it right now. First of all is the definition. For cost accounting, we do classification, recording, presentation, and interpretation of the cost involved in the manufacturing and selling of each product, job, and service. But for financial accounting, we do analysis, classification, and recording of financial transaction and the ascertainment of how such transaction affect the performance and financial position of the business. Second, we have the objective. The objective of the cost accounting is to ascertain and control costs and maximize efficiency. The main purpose is to provide cost information to the management. For the financial accounting, the main purpose is to prepare a profit and loss account and balance sheet for reporting to outside party. The third aspect is about the focus of users. Cost accounting focuses on the reporting to internal users of accounting information such as managers. Meanwhile, for financial accounting focuses on reporting to external users of accounting information including investors, government, regulators, shareholders, creditors, banks, and suppliers. Next is about the time dimension. Cost accounting focuses on present and future data to provide information that the management needs to plan and control the organization's activities and to make decisions about the future. Different from cost accounting, financial accounting made reports on what happened in the past to draw up financial statement, the historical data, for the external user to see how well the business financial is. The fifth aspect is about format. There are no specific format for cost accounting reports. They are prepared in the format decided internally by the firm, in the format which most suits the users. But for financial accounting, the financial statements are prepared in the format prescribed by regulatory bodies. After that, we have the sixth aspect, which is about the report frequency. For cost accounting, the data and statements are prepared whenever needed. For an example, monthly, weekly, or daily. But for financial accounting, financial statements are prepared for a definite period of time, usually a year. There are also differences in the accounting method. The cost accounting is not based on the double entry system, but financial accounting follows the double entry system while preparing the financial reports. Other than that, there are also differences in the regulatory requirement. No mandatory rules or regulations are required to be adhered for preparing report. Any accounting techniques that generate useful information can be used in the cost accounting. But in financial accounting, we must follow the regulatory requirements such as the Companies Act, Income Tax Act, and Generally Accepted Accounting Principles, GAAP, when preparing financial statements. The segmentation in cost accounting is the cost accounting reports focus on small parts of the organization such as customers, services, products, and activities. Meanwhile, the segmentation for financial accounting is the financial accounting reports describe the whole of the business. The unit of measurement that have been used in the cost accounting may apply monetary or non-monetary units of measurement. For example, machine hours and labor hours. But in the financial accounting provides information in terms of monetary units only. For example, Ringgit Malaysia. Last but not least, the difference about reports. Cost accounting generates special reports and analysis as required by management. For example, sales report, cash budget, and variance analysis. In financial accounting, generate financial statement include income statement and balance sheet, cash flow statement, and financial statement analysis such as ratio analysis.
I'm Nur Shafiza binti Jamruddin will explain about cost unit and cost center. A cost unit is defined as a unit of quantity of product, service or time in relation to which cost may be ascertained or expressed. In other words, a cost unit is a standard or unit of measurement of the goods manufactured or service rendered. A cost unit may be expressed in terms of number, length, area, weight, volume, time, or value. A cost unit must be certain or definite and not change over time, and it must be simple to understand and to quote, and lastly, it must be universally accepted. A cost unit normally apply in different industries. For example, electric company use cost unit per unit. Transport companies use cost unit per kilometer, and oil companies use cost unit per liter. Alright, now let's proceed about cost center. The Institute of Cost and Management Accountants, ICMA, which is based in London, define a cost center a location, person or item of equipment for which cost may be ascertained and used for the purpose of cost control. A cost control in a company is formed by considering the convenience of cost accumulation, comparability, and cost control. A cost centers may be divided into two parts, that is, production cost centers and service cost centers. A production cost center refers to a cost center that is engaged in regular production. For example, is converting raw materials into finished products. A service cost center is a center that is not engaged in regular production, but which assists the production cost centers in implementing their activities, like store department, personnel department, or maintenance department. Cost center can also be divided into operation cost centers and process cost centers, as well as personnel cost centers and impersonal cost centers. Operation cost centers are cost centers that consist of machine and persons carrying out similar operation, while a process cost center is one that consists of a specific process or a continuous sequence of operations. A personnel cost center is a cost center that consists of a person or group of persons. For example, is departmental foreman, salesman, supervisor, and factory manager. An impersonal cost center refers to a cost center that consists of a location, item of equipment, or a group of these. For example, is machine, departments, and vehicles.
Cost object. A cost object is a managerial term for a product, process, department, or customer that costs originate from or are associated with. In other words, it's something that costs can be identified with and traced back to. For an example, when a company makes a product, it spends money on raw materials. This cost can be traced back to the products that the materials went into. Thus, the product is the cost object. It generates the cost and all the expenses can be traced back to it or associated with it. Keep in mind that anything that generates cost or has expenses associated with it can be considered a cost object. This isn't reserved to just products. A department like the sales department can be an object. There are many selling expenses that are traceable back to the sales department, including rent for selling space, sales staff salary, and displays for promotion and selling purpose.
Next, I will explain about conversion costs and opportunity costs. Conversion costs are the total of direct labor and factory overhead costs. They are combined because it is the labor and overhead together that convert the raw material into the finished product. In other words, conversion costs are a manufacturer's product or production cost other than the cost of product's direct materials. Expressed another way, conversion costs are the manufacturing or production costs necessary to convert raw material into products. For example of direct labor are the employees working on the assembly line of a manufacturer. Then, example of manufacturing overhead include the utilities, direct labor, repairs and maintenance, depreciation and others that is occurring within a company's manufacturing facilities. Next, opportunity cost. Opportunity cost is the profit loss when one alternative is selected over another. The concept is useful simply as a reminder to examine all reasonable alternatives before making a decision. For example, you have 100,000 and choose to invest in a product line that will generate a return of 5%. If you could have spent the money on a different investment that would have generated a return of 7%, then the 2% difference between the two alternatives is the foregone opportunity cost of this decision. Opportunity cost does not necessarily involve money. It can also refer to alternative uses of time. For example, do you spend 20 hours learning a new skill or 20 hours reading a book? For another example of opportunity cost is go on vacation now or save the money and invest for a house.
Incremental cost is the extra cost that a company incurs if it manufactures an additional quantity of units. For example, consider a company that produces 100 units of its main product and decides that it can fit 10 more units in its production schedule. The additional cost it will incur for producing these 10 units is the incremental cost.
Replacement cost is term referring to amount of money spent to replace an essential asset. Replacement cost may fluctuate depending on factors such as the market value of company used to reconstruct or repurchase the asset and the expense involved in preparing asset for use. Example, an essential asset, a real estate property, and an investment security. Sometimes replacement cost referred to as a replacement value.
Sunk cost. Sunk cost, also known as retrospective cost. A sunk cost refers to money that has already been spent and cannot be recovered. Sunk costs are contrast with prospective costs, which are future costs that may be avoided if action is taken. Some paid in the past that is no longer relevant to decision about the future. The key is sunk costs are those which have already been incurred and which are unrecoverable. In business, sunk costs are typically not included in consideration when making future decisions, as they are seen as irrelevant to current and future budgetary concerns. Sunk costs are in contrast to relevant costs, which are future costs that have yet to be incurred. Hi everyone, my name is Muhammad Faid Akmal bin Muhammad Anwar. For the topic 1.2.1, I will present the accumulation and assignment of costs for different functions. The accumulation is the process of collecting cost information about the business with help of the cost accounting system. It is a process of collection of all relevant data regarding the various costs incurred by the company at various stages of the production. This calculation is the result or outcome of cost accounting system prevent or practice in the company. Cost accumulation calculate all manufacturing costs in sequential pattern. It considers all costs in the production process, starting from inventory to the finished good. The focus and the objective are to come up with the cost of particular product or service by identifying various cost objects and their respective cost driver. Here there exists a cause-effect relationship between cost object and their cost drivers. Those cost accumulation become a very connected and integral part of the cost accounting system. And the second one is assignment cost. Assignment is the allocation of cost to the activity or object that trigger the incurrence of the cost. The concept is heavily used in activity-based costing, where overhead costs are traced back to the action causing the overhead to be incurred. The cost assignment is based on one or more cost drivers. Example of a cost assignment: a university operates its own maintenance department. The cost of department is assigned to the various other departments of the university based on their consumption of the department maintenance service. Terms similar to cost assignment is also known as cost allocation.
Assalamualaikum and hi everyone. My name is Danish Daniel Reza bin Rosli. My matrix card number is 01DAT20F1022. Okay, now I want to present my part, which is 1.2.2 cost accumulation for the purpose of stock valuation and profit reporting. Alright. Different costs have different behavior patterns in response to change in activity, influenced by several factors. Cost accumulation involves the use of a formal cost accounting system to collect cost information. By collecting and analyzing cost information, management can make more informed decisions about the operations of a business. Okay, as we can see, at the top of right, we have the example for elements of the product cost. Okay, now we have two costs, which is product cost and period cost. Product cost is all costs that are assigned to inventory or finished goods, while period cost is all expired costs that are not required for production. Examples of period costs are salaries of sales personnel, depreciation of office equipment, advertising expenses, and salaries of top management. Okay, now it's my friend's turn to present about the cost accumulation for the purpose of decision by using high-low method, and so on.
Assalamualaikum warahmatullahi wabarakatuh. My name is Noah Kemasinah binti Muhammad Azmi. My matrix number is 01DAT20F1029. Now, I want to discuss the cost accumulation for the purpose of decision making by using high-low method. The cost is fixed cost, variable cost, and semi-variable cost. Definition for the fixed cost is that cost remain constant at all level of output and will accrue if no output was produced. Next, for the variable cost is that cost change in direct proportion with production activity. Then, semi-variable cost contain both or combination of variable and fixed cost. Now, we have to know what is high-low method. High-low method is cost accounting term that helps to separate out fixed and variable cost in case company limited amount of data. This method involves taking the highest level of production and the lowest level of production, and then we compare the total cost at each level. This method helps determine the variable and fixed cost if the variable is fixed per unit and fixed cost is same for all volume levels. But this method could give inaccurate result due to the depends on two extreme value, which is the highest and the lowest.
From this method, we can see that the high-low method is fairly crude way of estimate the fixed and variable cost element of semi-variable cost. Formula of high-low method have three working parts, which is we have to get variable cost and fixed cost to get total high-low cost. First, we have to calculate variable cost. The formula is variable cost equal to total difference between highest and lowest production level of cost divided to total difference between highest and lowest production level units. Then, to calculate fixed cost, the formula is fixed cost equal to highest production level of cost minus total of variable cost times highest production level units. Lastly, the high-low cost. High-low cost formula is fixed cost times total of variable cost times unit production.
For last point, I will explain about cost accumulation for the purpose of planning and control. In this course, we will cover many cost classification useful for planning and control. That is, fixed versus variable cost, direct versus indirect cost, controllable versus non-controllable cost, differential cost including sunk and opportunity cost. For this topic, I will highlight about controllable versus non-controllable costs. Alright, firstly, we look at controllable costs. Controllable costs are costs that can be influenced or regulated by the manager or head responsible for it. Controllable costs are things the executive, manager or department even can control or change. For example, we can look is direct materials, direct labor and certain factory overhead costs are controlled by the production manager. And another example is the manager's salary. The manager has no control over his own salary and has no power to change or stay within the budget for the salary. Controllable costs are things the executive, manager or department even can control or change. If the executive, manager or department cannot change or control the cost, it is non-controllable cost. Non-controllable costs, from the term itself, controllable costs are those that are not under the control of a specific manager. This cannot be influenced by decisions or actions of the manager. These costs are imposed by the top management or allocated to several departments. For example, a company-wide advertising cost that is allocated by the central office to different departments is not under the control of the department heads. And another example for non-controllable costs would be an allocation of administrative expenses to each job or department.